So with the market trading at all new highs, there's a big, huge undercurrent of disbelief and fear. And so we're going to walk through a couple of charts and show that. So, but I think the point of this is you've got to follow the trends. If not, you're going to be left behind. So stick with me as we explore that. My name is Bryan Cannon, and welcome to Markets in 5. So I'm going to share with you 3 charts today. The first one's going to be the S&P 500. It's going to look pretty familiar. But all 3 charts today are going to kind of focus on that theme of really following the charts. I'd like to see, people turn off the television, quit formulating their own thoughts or opinions of what might happen, and listening to the talking heads on television. They don't know. So, I think the important thing is follow the trends. If the trends are up, you've got to be in it. If the trends are down, then you reassess and you do what's in your risk tolerance. What we're seeing right now is, the S&P has broken out to all new highs, and that's a great thing. So could it come down here and retest this prior peak? Yeah, absolutely it can, and probably will at some point. But for right now, it's we can't deny that we are in an uptrend. It's higher highs and higher lows, and we've broken out to the upside. So you've got to participate, even if you feel like the market's going to drop down. You've got to hold your nose and be in. So now we're seeing some warning, some cracks in the wall, if you will, of the dam. So we'll see. We've got a negative divergence here that's been formulating. Negative divergences are not guaranteed to be reversal signals, but oftentimes they are. But it also doesn't happen in the time frame in which you want it to, right? So it could happen fairly quickly. It could take a while to formulate, and it may never transpire, but a lot of times they do. So we do look for the signs like negative divergences to determine, are we topping and are we more poised to roll over than go up? And at this point, the data's not in. We don't know yet. All right, so this is an interesting chart. This is the S&P 500 compared to the 10-year Treasuries. And so obviously you saw the S&P 500 last year really kind of struggle through basically the second and third quarter. And then it hit the fourth quarter and just took off. And conversely, the 10-year Treasuries took off and hit an all-time high, and they were running. So when you compare kind of the bottom of where the S&P was to where it is now, it's up 37%. So again, if you're sitting on the sidelines and you feel like the sky's going to fall, you missed out on a massive run to the upside. Conversely, if you in the same time took your money out of the market and put it in Treasuries because you felt like you wanted safety and security as opposed to risk, conversely, the from the peak to where we are now, 10-year Treasuries down 15%. So it pays to follow the trends. It pays to stay on the right side of the trends. And so when we get a crossover to the downside and we're using all our indicators, and we see the Treasury, 10-year Treasury going down, well, we want to lighten the load on that position or possibly exit it. Now, conversely, if we're kind of sour on the S&P and it comes down and finds a bottom and breaks out to the upside, we got to hold our nose and get back in. So, that's it's important to follow the trends. All right, the last chart I'm going to share with you is the S&P 500 and the VIX, and then the correlation of the two. So, the S&P 500 historically, when they are highly correlated, meaning the S&P is up and the VIX is up. The VIX is a measure of volatility or fear in the marketplace. And so when you've got an S&P 500 that's up and you've got fear that's up, usually in the past, if you look at all these circles, that's kind of the correlation where they're highly correlated. Normally they're not. So just to kind of think about it, if the S&P is up, usually the fear comes down, right? So they're usually kind of, they work against each other. So when they work in tangent, meaning that the market's up and the fear is up, it tells me that there's some disbelief in the move of the market. So we've had a highly correlated S&P and VIX reading here for a while. Basically, this whole year, it tells me that no one believes this move in the S&P 500, which is why I'm putting together this episode to basically say follow the charts. Quit putting your own kind of hypothesis into what or why, and just follow it. So as you can see, if you let emotions and headline news drive your investment decisions, it's going to be a big mistake. So you've got to follow the trends, and if the trends are heading up and you've got higher highs and higher lows, you've got to be in. Sometimes you got to hold your nose, but you got to stay the course. And, if you do go to cash, you better have a strategy to put it back to work at lower levels, or it's all for none. So that's my 2 cents for the day. If you have any questions, give me a shout, and I look forward to seeing you on the next Markets in 5.